Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to the Cut to the Chase. Today is Tuesday the 10th of September. I'm Steve Brice, standing in for Daniel Lam, who is competing in the Chess Olympiad in Budapest. The focus recently has been on the weaker than expected US employment report and whether the Fed will cut interest rates by 0.25% or 0.5% next week. We will return to this tomorrow when we look at US inflation data, which is due out later in the week. However, tonight attention will shift to the US presidential debate. Kamala Harris has clearly reinvigorated Democrat chances of winning the presidency. 538 polling data suggests Harris has an almost 3% lead in the national polls, but this is largely irrelevant. In 2016, for instance, Hillary Clinton won 2% more votes than Trump, but she only won 232 electoral votes compared to Trump's 306. So it's the swing states that matter, and in 2024 there are swing states. Now, if I look at the 538 polling data, this suggests the split between clear red and blue states is pretty even, so 214 to 218. And this leaves 106 votes up for grabs in the swing states, hence the importance of tonight's debate. To complicate matters further, for investors what matters is not just the president, but also the makeup of Congress. Now, our view is that a Trump victory with a split Congress would likely be the worst outcome for markets, as you get the negatives from trade and immigration policies without the offsetting benefits of further tax cuts and deregulation. If Trump continues to gain ground, therefore, this could lead to more volatility as the worst-case outcome rises in probability. Alongside a weakening economy and heightened geopolitical concerns, this is one of the reasons for our decision to reduce our allocation to global equities to neutral for the time being. This is effectively taking profit on our overweight position we've had through the start of the year. And we believe US financials and healthcare might be a decent place to hunker down in short term. Closer to home, in Asia, markets followed the US sell-off on Friday with their own version yesterday, with China's index, CSI 300 index, seemingly closing in on January's lows. China was hit by weaker than expected inflation data, with core inflation standing at a mere 0.3% year on year, precariously close to deflation. However, the authorities are unlikely to ease policy dramatically and only ease policy gradually, as they remain keen to avoid any acceleration of debt creation. And this to us means that a sharp, sustained rally in Chinese equities looks unlikely, although short-term retracements from oversold conditions remain possible, and obviously the bounce in US markets overnight creates a much better backdrop, at least for today. So that's it from me today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a fantastic day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.